The Opposing View Podcast. Episode, Will the Dollar Remain the World Currency? Welcome to Opposing View, the podcast where two expert minds face off over one crucial question: to sharpen yours. Today, we explore a subject that quietly underpins the entire global economy, yet most people rarely question it. Today's motion, will the dollar remain the world currency? We are entering into a global currency shift. For over 70 years, the US dollar has been the planet's reserve currency, the benchmark for trade, debt, and financial trust. But cracks are beginning to show. Rising U.S. debt, geopolitical shifts, and growing challenges from China, the BRICS nations, and digital currencies. Is the dollar's dominance a permanent feature of the global system, or a historic anomaly whose end is near? To unpack this, we bring together two experts who approach the question from starkly different perspectives. Expert Introduction. Our first guest is Dr. Ayumi Takeda, a monetary economist from Singapore. Her research focuses on currency multipolarity, central bank diversification, and the internationalization of the Chinese yuan. She has published extensively on de-dollarization trends in Asia and Africa. Joining her is Dr. Thomas Wakefield, an American-born economic historian based in Europe. He specializes in monetary hegemonies, reserve currency transitions, and systemic financial stability. He's been analyzing the structural role of the U.S. dollar since the 2008 global financial crisis. Dr. Ayumi Takeda, opening argument.
Thank you. The question we're asking, whether the US dollar will remain the world currency, already assumes a continuity that is increasingly out of sync with global realities. Let me begin with a basic historical reminder. No global reserve currency lasts forever. The Dutch guilder dominated in the 17th century. The British pound sterling reigned through the 19th. Each lasted roughly 80 to 100 years before being displaced. The dollar has enjoyed dominance since Bretton Woods in 1944. We are now entering year 81. The warning lights are flashing. First, look at the foreign reserves. According to IMF data from the first quarter of 2024, the share of global reserves held in US dollars has dropped from 71% in 1999 to under 58% today. This is not a small shift. It's a long-term, accelerating trend. And it's not just going into euros or yen. The yuan now comprises over 5% of allocated reserves, up from less than 1% a decade ago. Second, trade settlement patterns are changing. In March 2023, China and Brazil announced that they would settle bilateral trade directly in yuan and reais, bypassing the dollar entirely. In 2024, the same was agreed between China and Saudi Arabia, the world's second-largest oil producer. This matters. It means petrodollar dominance is eroding, and with it, the dollar's artificial demand. Third, we must consider U.S. fiscal credibility. The Congressional Budget Office projects that U.S. federal debt will exceed 130% of GDP by 2033, driven by structural deficits and political gridlock. That's not just unsustainable, it's dangerous. Trust in the dollar is built on trust in U.S. institutions. But what happens when those institutions appear dysfunctional? Finally, there's the rise of digital currencies. China's digital yuan, piloted in over 20 cities and used in cross-border settlements via the M-Bridge project with Thailand and the UAE, signals a future where state-backed alternatives are more efficient, programmable, and politically aligned with emerging economies. To summarize, the dollar isn't collapsing, it's being quietly rebalanced out of the system, not through crisis, but through diversification. That's the new logic of a multipolar world.
A compelling case that the dollar's dominance is not guaranteed, and that the future may be one of currency fragmentation rather than continuity. But is this shift real, or just another cycle in a story of enduring American financial leadership? Let's hear from Dr. Wakefield. Dr. Thomas Wakefield, opening argument.
Thank you. Let me offer a very different perspective. The US dollar is not just surviving, it's winning by default. Yes, alternatives are emerging, but none offer the combination of scale, trust, liquidity, and legal reliability that the dollar provides. That is the heart of reserve currency status, bar not symbolism, but functionality. Let's talk scale. 88% of global foreign exchange transactions still involve the US dollar, according to the Bank for International Settlements 2022 Triennial Survey. That number hasn't moved meaningfully in 20 years. The euro, about 31%. The yuan, just 7%. The yuan is growing, yes, but it's not even close. Now, trust. The dollar is backed by deep capital markets. The U.S. Treasury market alone is worth over $25 trillion, and it's liquid 24/7, even in crisis. No other country, not China, not Germany, not India, has anything comparable. During the COVID crash in March 2020, global investors rushed into dollars. Why? Because no other currency offers such depth and exit capability. Let's talk about legal institutions. When a contract is written under U.S. law and denominated in dollars, parties across the world know the rules. They know the courts will enforce the terms. That legal reliability is invisible until it's necessary. No, and then it's everything. Would you rather have your sovereign wealth fund savings in Beijing's court system or in New York? Finally, let's consider China's limitations. Yes, the digital yuan is innovative, but capital controls in China remain severe. The yuan is not freely convertible, and investors know this. In 2015, when the Chinese stock market crashed, Beijing halted currency outflows and banned short selling. That's not how you build international trust. Reserve status is earned through decades of performance under stress. The dollar has been tested again and again, and each time it emerged more central, not less. From the 2008 financial crisis to the 2022 sanctions regime on Russia, the world continues to operate through the dollar, even when it wants not to.
This is not inertia, it's logic. And until another currency can match the dollar in every dimension, it remains the world's backbone. Rebuttals. Two sharply defined views. One sees decay, the other sees endurance. Let's return to Dr. Takeda for her response. Rebuttal 1. Dr. Ayumi Takeda.
Thomas, your argument assumes that performance equals permanence. But history suggests otherwise. You cite market depth and legal reliability, and those are real. But they're not fixed in stone. Let's not forget that the pound sterling had similar advantages in 1900. Deep London markets, imperial trade networks, widespread legal trust. By 1945, its reserve share had collapsed. Why? Because geopolitics matter. The United States today faces declining global favorability. In 2023, a Pew Global survey showed that across Latin America and sub-Saharan Africa, confidence in US leadership fell by 15% in just 2 years. This matters when countries choose whom to align with financially. You mentioned dollar flows during crisis, but many of those are forced because countries must buy energy or repay debt in dollars. This creates what economists like Barry Eichengreen call exorbitant privilege, an artificial demand created by system design, not genuine preference. And on legal institutions? I agree, US courts are respected. But what about weaponization of finance? The 2022 swift cutoff of Russia's banks and the seizure of over $300 billion in Russian central bank assets was a seismic event. Regardless of political justification, it sent a message to every non-Western nation. Your reserves are only yours if the US says so. Since then, countries like India, Turkey, and Indonesia have ramped up local currency settlement programs. They don't want their sovereignty to be hostage to dollar politics. The dollar is still powerful, but it has become politically expensive. That cost is pushing the world, quietly but firmly, toward alternatives.
A sharp challenge to the assumptions behind dollar dominance and a reminder that trust, once questioned, changes behavior. Dr. Wakefield, your counter? Rebuttal 2. Dr. Thomas Wakefield.
Ayumi raises valid concerns, but I think she's drawing the wrong conclusions. Yes, financial power can be abused, but you don't abandon the fire department because one day it might flood your basement. The dollar is not a weapon. Yeah, it's a framework, and that framework still functions better than any alternative. Let's talk about the SWIFT cutoff. After sanctions on Russia, many assumed countries would flee the dollar, but what happened? The Indian rupee faced liquidity issues when used for oil trades. Russia demanded gold or yuan, but that locked them into tighter alignment with Beijing. Hardly ideal. And most major companies, from Maersk to Shell, continued pricing in dollars because the infrastructure wasn't there to change. When push comes to shove, inertia favors the incumbent, and in systems as large as global finance, that's a powerful advantage. Now, on central bank reserves, 58% is still a majority. The euro, yen, and yuan combined don't reach half of that. And many sovereign wealth funds, like those in Norway, Saudi Arabia, and Singapore, have not meaningfully reduced their dollar exposure. Finally, the idea that the world will move to a basket of currencies ignores human behavior. When the world is on fire, people don't want complexity. They want clarity. And the dollar still provides that.
Closing remarks. A fiery exchange on what holds the financial world together and what might one day replace it. From reserve trends to energy flows, digital experiments to geopolitical fault lines, this episode shows us that currency power is both technical and deeply political. Whether the dollar remains dominant or yields to fragmentation, one thing is certain. Money is never just about numbers, it's about trust. Until next time, stay critical, stay curious.